Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Tuesday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio performance, how it's been doing for the day, week, month, etc. We're going to go over the buying power, exactly how the individual stocks are performing to see if there are any deals within the portfolio, as well as we're going to look at the watch list and see what prices I'd buy Berkshire B, I'm not rich enough for a Class A share, and Meta or Facebook. We're going to take a look and see where I will want to buy these stocks in the future. Jumping right in, for today, we are down $46, but we are up $105.57. Then for that 1 week mark, we're up $628.93 with a 1.23% return for the past week. Then that 1 month mark, we're in the red, $37.90, a 0.07% return. Then we are up $1,482.01 with a near 3% return in the past 3 months. Then year to date, we are up $1,987.88 with a 4% return year to date. Then we're up $2,522.19, a 5.12% return for the past year. Then all time, we are up $16,480.91, a 46.64% return all time. Now, guys, one of the things that I love about investing is there is always an opportunity if you're willing to look for it, as well as volatility is our best friend. In the short term, guys, anything can happen. In the short term, the stock market is a voting machine. Everybody has an opinion. Everybody's worried about short term, about could be news reports, could be earnings misses, could be a complete shift in a business, whatever it is, guys. There's always a reason to be scared in the stock market. But if you understand the fundamentals of your businesses and you understand that in the short term, the market is a voting machine based on emotion, how people feel, where people assume or think the stock market is going versus the actual businesses that you own, the fundamentals and the earnings. If the earnings are going up, the stock price will follow. And so in the short term, I don't care what happens to my portfolio. I could lose 30% in a day. That's not going to sway me. I'm still going to own the same companies unless something fundamental changes about the business. Unless there's a CEO change and I don't like the way he takes the business or she takes the business after they take the helm. Maybe maybe there's a shift. Maybe they're going to change the iPhone look, or maybe they do a couple investments or acquisitions that I don't agree with, and they spend a lot more money than they should on acquisitions, something like an AT&T buying DirecTV or buying Warner Brothers Discovery and then having to spin it out because it didn't help their core business. They got distracted at AT&T. They were trying to be an everything company when really their core focus should have been their telecom business, and it bit investors in the ass. People lost a lot of money when it came to spinning out DirecTV and spinning out Warner Media, and the stock still hasn't recovered. So that's something that, because I owned AT&T as well, that's something that in the short term, it sounded great. Oh yeah, people can watch the content on their phones. And then eventually it turned into, what are we doing? We're not even, we're a telecom company and this has nothing to do with our main business. So that is something that I would sell out of a company for, is changing in the management or changing in the vision of the business. But guys, that's why I own the stocks that I do. I have learned from stuff like AT&T, from that shift, from that change fundamentally in their business. So that's why I love investing, because you learn as you go. Every single, purchase, every single change in the portfolio, every earnings report, anything and everything can be a learning experience. So our buying power is 28.76 right now. We're going to jump in to Realty Income, 170 shares. Stock is now at $55.08, $9,300 worth of market value. Average cost is $65.03 with 18% of the portfolio in Realty Income. We're down $61.20 today. Total, we're down nearly $1,700 with a 15% loss on Realty Income. But guys, I love that this stock is down. I love the monthly dividend income In fact, they have that copywritten, I believe, that they are the monthly dividend paying stock. O pays me a dividend every single month in the middle of the month. So May 15th, I'm getting paid $43.69. And guess what, guys? The reason I love Realty Income so much is because it gives me exposure to real estate without the headache. Okay, I don't have to deal with tenants. I don't have to deal with getting calls about a leaky faucet or a plumbing issue with a toilet or a furnace going out or a water heater needing replaced or a roof needing repaired. None of that BS comes with owning this stock, and that's why I love Realty Income. I get great real estate exposure without the headache, without the credit checks, without tenants ruining my properties. They do it all for me, and I get a nice check of $43 a month. Now, I know $43 isn't a lot of money, but I had to do very little to get that money. I just had to put my money in the stock market, own a quality business that owns quality tenants that have they have a triple net lease, and they get paid every month, and then I get a portion of the rent checks that they get every month. And the beauty of it is they don't have to pay, they don't have to do upkeep, they don't have to deal with utilities, and they have escalated rents built into their contracts with their tenants. So I'm guaranteed more money based on the contracts that they have with those tenants. And I do love the tenant pool. They have Dollar General, Dollar Tree, they have Walmart, Sam's Club, Walgreens, CVS. So they have a lot of high quality tenants. And I think that overall, I would rather own this than a property because there's a lot less risk in owning a monthly paying stock versus the headache that may come with real estate. And guys, sorry, as of right now, it is the best buy within the portfolio. Then we've got Alphabet stock closing at 172.36. I did buy another share with that Altria dividend, so I have 2 shares now. Market value is about $340. Average cost is $161.14. 0.67% of the portfolio is in Google, so nearly 1% here, with a total return today of $5, a 1.5% return, but total over the course of the past month, because I've only owned this for about 30 days, and I just added another share. We're up $22.43 with a near 7% return within a month. That's great. I do want Alphabet or Google to be one of the biggest positions in the entire portfolio. Right now, I want it to be number 4. I want it to go Apple, Visa, CocaCola, Google, and then Berkshire. So I will be putting a lot of capital in Alphabet. Next, we got Coca-Cola sitting at $62.71. We have 15 shares, $940 worth of market value. Average cost is $60.54. Right around 1.8% of the portfolio is in Coca-Cola. Today we're up $5.40. Total we're up $32.48 with a near 4% return here on Coca-Cola. And guys, it's not up that much compared to my average cost, so I would buy Coca-Cola at these levels. Then we've got Altria. Now, guys, this is one of those positions that I do not plan on adding to. It's a huge position. It brings in great cash flow. I just want to use it to buy something else, a higher quality business. Now, guys, I did smoke for a handful of years, so I put money in this originally to get some money back from my investment in smoking. So I have a different reason. I know morally it's a stock I wouldn't want to own, but I put money into this industry, so I want to get a little money out of it as well. So I have 320 shares, $14,000 worth of market value. Average cost is $47.27. 27% of the portfolio is in Altria. Today we're up $108. Total we're only down $1,100 with a loss of 7%. Guys, here's my long-term thesis on Altria. Yes, smoking rates are going down. They have had alternative investments that have not worked out the greatest, but I still think there is some growth potential in the industry. They have pricing power with their Marlboro brands, and it's an addictive product, so people will keep smoking. They are lifetime users most of the time, and I think long term, even though smoking rates are going down, I think they have enough pricing power that they can keep paying the dividend and increasing it little by little each year. And guys, I'm okay with that because I'm using Altria's cash flow to buy Google, Berkshire, Facebook, Coca-Cola, whatever is a good deal when this stock pays on that 147.10. I'm going to use this money to make the portfolio grow more. That's the real long-term goal. So yes, it's 27% of the portfolio right now at 28. I'm 28 years old. When I'm 30, it's going to be a smaller percentage because I'm going to have more money in Google and in Apple. My goal here is to make Apple a $40,000 to $50,000 position. My goal with Visa is to make it a $50,000 position. Goal with Coca-Cola, like a $24,000 to $25,000 position. Google, I want it to be right there with Coca-Cola or even surpassing it at 30 to 40K. And then, of course, Berkshire and Facebook, I want them to be around 30 to 40K. So I want them to be massive positions. Eventually, I want to be able to use the dividend from, even though it's small now, from Google or Facebook to buy themselves. I want to be able to use the dividends from Altria to buy more growth-oriented companies and then have those growth-oriented companies invest back into something like a Coca-Cola or an Apple. So Altria is being used to grow the portfolio overall. Even though I know Altria might lag here for the next few years, I'm okay with that. I'm okay with it being flat because then it gives me buying opportunities. It's a hated industry. It's a sin stock. People do not like the company, which is great. It has PR disasters left and right. So I know the business fundamentally. I understand the challenges that, of course, come with tobacco. And I think I can take advantage and buy at cheaper prices. But the main goal for Altria is to use the cash flow to buy something like Google or Berkshire for the long term. So even though it's 27% of the portfolio, eventually it's going to say something like 7.08% of the portfolio. Then we've got Apple, guys. This is by far my favorite stock. So Apple's 182.42, one share. Of course, market value reflects the stock price. Average cost is about $133 per share. 0.35% of the portfolio is in Apple. That's going to go way up. Eventually, I wanted to say something like 35 to 40%. I would not mind copying Buffett and making Apple 50% of my portfolio eventually. Today, we're up 71 cents. Total, we're up nearly $50 with a 37% return. So guys, I bought this with dividends. That's why I love dividend growth investing. I didn't have to put any cash. Actually, at this point, when I bought Apple stock, I was actually fired from my job. I got let go. They did massive layoffs at the company I was at, and I just happened to be one of the people that got let go. So I bought the stock because I was bummed out. I had just lost my job, and I got paid by Altria. I'm like, you know what? Fuck it. I'm gonna buy Apple because it made me feel, it made me feel better in a tough time. So I love Apple, and I do want it to be the biggest position in the portfolio. Next, we've got Abbvie at 162.69, 95 shares, $15,000 worth of market value. Average cost is right around $95 per share, which makes me cry because it makes me feel like I'm never going to be able to buy the stock again. Around 30% of the portfolio is in Abbvie. Today, we're down $380. Total, we're up $6,400 with a near 71% return, 70.91% return here. Abbvie's dividend is being paid on May 15th, the same day as O, and it's $147.25. So guys, when I originally bought Abbvie, the dividend was $1.07. So not only has the stock appreciated immensely, but it also has grown the dividend quite aggressively as well. And I know there were a lot of people that were worried about Humira and the drop-off in profitability from Abbvie, but I think the new drugs like Skyrizi have really helped cushion the blow of losing the exclusivity of Humira. So I'm not as worried about it. I looked at their pipeline before it dropped off, and I'm like, you know what? I could have switched out, but I'm gonna let this flower grow, right? That's a Peter Lynch. It's a Peter Lynch saying. A lot of people cut their flowers and grow their weeds, right? In my opinion, Altria is the biggest set of weeds in the portfolio. And I know that. I understand that. I'm using it to grow the garden more aggressively because I wouldn't get the same amount of dividends, and I don't have $313 a month right now to be putting into the portfolio. So for me, it makes sense to leave that money stuck in there with Altria. Even if it doesn't get a great return, it still gives me a lot of cash flow, and then I can buy something like an Abbvie or a T. Rowe Price, a Google. So that's the goal. And the thing is, guys, if I am right on the stocks, if I'm right on my picks, I will have another Abbvie. I think T. Rowe Price could be Abbvie Part 2. But I'm happy with 30% of the portfolio being in Abbvie. I have nothing but respect for the management team. They are very good at allocating capital, and they honestly did a blockbuster job of replacing that revenue from Humira. It's not going to be perfect. I'm sure they haven't completely replaced it yet, but I do think the profitability for the company is good long term. Then we've got Visa, guys. So this is one of my favorite companies. It's going to be the number 2 spot, the second biggest position. Right now, sitting at right around $276 per share. It's up kind of big today, up $4. We have one share, of course, $276.45 is our market value. Average cost is right around $269 per share. 0.5% of the portfolio is in Visa. Today, we're up $3. Total, we're up $8. So definitely in my buying range right now. We're up 3%. I would buy this all the way up to $300, guys. So I don't mind kind of making my average cost go up on Visa, considering it's such a great business, has great margins. The dividend growth is insane. So I love Visa. I want it to be the second biggest position in the portfolio, and I think this will be one of the biggest growth drivers of my future portfolio, and I'm going to be ecstatic when that says like 40 to, I mean, I want Apple to be about, say Apple's 40% of the portfolio. I wouldn't mind Visa being 20 to 30%. So like 70% of my portfolio could be in Apple and Visa, and I would sleep fine at night. Then we've got T. Rowe Price, 100 shares sitting at 112 even right now, $11,200 of market value. Average cost is around $110 a share, so I would buy it here at these prices. 21% of the portfolio is in T. Rowe Price. Today we're down $1. Total, we're up $227.11 with a 2.07% return. Guys, I love T. Rowe Price, and let me tell you why I think long term this business is going to do ecstatic. Excuse me, is going to be a very good business. Sorry, I meant to say I'm going to be ecstatic if it goes right. So, guys, the reason I'm so bullish on T. Rowe Price is this long-term chart. So, of course, everything went down like crazy during the pandemic, right? So, I bought it around 110. So, say I bought it around, here or so, 2019. I actually bought it over here. But it's been as low as like 88. So I'm right about in the middle. But guys, the long-term trajectory, I could double my price. So right now my average cost is 110. It's been 220 before. It's been 225, like 222 to 225. So I could get a 50% return on T. Rowe Price on $11,000. So this could be a $22,000 position. The dividend grows every year. It's a dividend aristocrat. And I could get a 50% return on the stock appreciation, as well as get that growing dividend. So this could easily be an Abbvie within the next couple of years. Now, of course, the stock's been super beat down, right? We had the COVID pandemic, and then it went way up, and then, of course, there was financial issues. Rates went up, and it just hasn't recovered yet, which is fine. I'm glad that it's still around 110. I'd buy it all the way up to 115 to 120, but I'm not going to be getting it I don't want to get it any higher than that, because I want to project a 50% return. So I'm happy owning T. Rowe Price and adding to it at these levels. Then, of course, guys, I wanted to jump in real quick and talk about Berkshire. So I went to the Berkshire meeting, loved it. It was kind of sad because, of course, first meeting without Charlie Munger there. But, guys, the 52-week low and high right now, the low is around 320. The high is 430. So I want to get it at around 350, maybe. I could stomach it at 400, but I'd want to cost down average from there. So I'm honestly happy to buy Berkshire at 350 to that $400 range. I know that's a really really high range, but I just want to get it added just like I did with Visa, so I can cost down average. But guys, I think they own like 100 businesses, so there's many reasons why I want to own Berkshire. One, I think that they are one of the best stewards of capital in the entire world. They're very good at insurance underwriting, which is honestly one of the most risky and hardest to predict businesses because of the economics of the business that they're in. They insure a lot of things that people wouldn't insure. They said that they insured like the Grammys a couple years ago. They've done like NHL games, football games. So if something goes wrong, they're paying premiums on that catastrophe. But they're very good at underwriting. They're very good at calculating their risk and getting paid appropriately, and then having reserves to cover that is the most important thing in insurance, and they're very good at that. So Greg Abel is going to oversee the CEO position after Buffett passes, and Ajit Jain is going to pretty much be his Charlie Munger, from how that's how I understand it. So they're going to have Greg Abel run everything except insurance, and Ajit run insurance, and I think that's phenomenal. So I think long term they have put the pieces in place to be very successful. And I know Berkshire's big, but they have done so well with their insurance. I just want a piece of that insurance and those premiums, guys. I've looked into Allstate, I've looked into Chubb, I've looked into Travelers, Hanover. I've looked into Mercury Financial. There's been a lot. Lincoln Financial as well. There have been a lot of insurance companies that I've looked into. Allstate as well. I love insurance. I understand the businesses, but I don't like how exposed they are to bad underwriting. And so the reason I want to own Berkshire is because I get National Indemnity, I get Wesco, I get like Gen Re, and I get Geico, as well as, everything. They have so many different insurance businesses. But I want that business model, but not just that business, because I think that sometimes insurance companies can be overexposed and not realize it and get bit in the ass. One of the reasons why I love Berkshire, and actually the biggest reason why I want to own Berkshire, is I get that business without that exposure to bad premiums. Because even if they do, say, lackluster underwriting, they still have all the cash flow from their publicly traded securities like Apple, CocaCola, Kraft Heinz. They have cash flow from that. Plus, they have like 150 or something like that businesses that they run independently, that they own, that are subsidiaries. So they have fully owned businesses that give them cash flow as well. So between those three things, good underwriting, as well as great fundamental businesses that grow over time, and a public stock portfolio that generates them massive cash flow, and they also have cash in treasury bonds that are giving them 5% right now as well. So they actually have 4 different ways that they generate cash. So they have treasury bonds, they have public stock market portfolio, as well as fully owned businesses and their underwriting profit, which is their float. I think that is the perfect way to own an insurance company. Now, I like Travelers, I like Allstate, I like Chubb. I've done extensive research on a lot of those companies, but one of the things that I don't like about the insurance business model that Buffett's talked about is their exposure to bad underwriting. And then once it starts, it snowballs sometimes, and it can get really dicey when it comes to insurance companies. So I love Berkshire because it has that exclusivity of having all those businesses and that cash flow. And if something goes wrong, they can still fall back on it. Their whole business isn't ruined due to bad underwriting, due to how they've set it up. And then, of course, we've got Meta, which I want to buy Meta around that $250 to $300 range. So I'm going to be sitting on the sidelines for a while. But guys, I use Meta every day. I understand the advertising business. I own Google. I use YouTube every day. I just jumped into Google first because I like the valuation more than I like Meta at these prices, but I will own it. Honestly, guys, both of them, if I had like 800 or 900 bucks right now, I'd just buy them both and cost on average. So guys, with that being said, I want to say thank you so much for watching. It does mean a lot. It helps my mental health every day to see the numbers going up, to get the positive feedback, get the likes, see people that are enjoying the journey. And like I said, guys, I'm like 6 years in, so volatility does not bother me that much. I just want to use the companies I have to buy better companies. So if something is what I feel less than Google or less than Apple, I'm not going to want to keep putting money into it if I have those companies at a good valuation. So thank you guys so much for watching, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.